Hi guys! Today we will talk about the 3 best ways to set a stop loss in trading. Because stop loss is a simple and effective tool to save you from really painful losses. So let's start right away. What is a stop loss? To start with the basics. A stop loss is an order that automatically closes your trade at a certain price. But why is it so important to set a stop loss? A stop loss is used as a protection mechanism to prevent your trading account against bigger losses and to secure profits in form of a moving stop loss or a trailing stop loss. But in this video we will focus first on the regular stop losses. So, how to set a stop loss? There are different ways. It depends on the strategy and the trader's preference and risk attitude. And it's always the result of a good backtest. It's important that the stop loss fits into your trading process. So the stop loss should work with the time frame, the market, the entry. It's important, are you working with a take profit or not? All these factors have to work together and fit into your trading process, and your stop loss also. So the stop loss is really individual. But now let's look at 3 different types to set a stop loss. You can either use technical analysis to find support and resistance levels and place your stop loss right there. Or you can place a fixed dollar stop or pip stop, like a $500 stop, for example, or a 20 pip stop. It also depends on your account size and your personal size of risk you feel comfortable with. Or as third point, you can use a dynamic indicator-based stop. For example, the ATR indicator. In this video, we are talking here specifically about stop losses. But there are also exit ways you can use instead of a stop loss, like a time stop, for example, or a chart pattern. But it always has to be tested really well before, so you have trust in your strategy and know if it's not going the right direction. It's okay, you don't have to worry. But we will go deeper into these options in a different video. In this video, we will really focus on the regular stop losses. So let's move on to the practical part of this video. We will start with our first stop loss using support and resistance levels. So let's go to the chart. We are in the Euro-US dollar 5-minute chart. And we have a nice resistance level over here. So if we would place an order, I will zoom in a little bit. If we would place an order, for example, after these 3 white soldiers, so we would have our entry here, and we would place our stop below the resistance level to make sure that we don't get stopped out by a spike down and then the market continues to go up further. That's what we don't want, therefore we place the stop right below the resistance level to leave a little space for the trade. After we learned how to set the stop loss using support and resistance levels, now let's have a look at our second stop loss option, placing a fixed dollar stop or a fixed pip stop. Let's go back to the chart. We're using the same entry as we used in the example before, after the 3 white soldiers. And using a fixed pip stop, let's say our trading rule says we are using 10 pips each time. So we would take our stop loss and place it at 10 pips. It doesn't matter that we're placing the stop loss right in the resistance area that we looked at before, because a fixed stop means that we use a fix every time, no matter which areas we put it into. This is because it's really important to have tested your strategy before really well, so you found out what works best for your strategy if the backtest said 10 pips work best, use 10 pips. Instead of the pips, you could also use the dollar stop and say if your account size is $10,000 and you want to use 1%, you can say, okay, I want to risk $100 per trade or 1% of the account size. In most trading platforms nowadays, it's really easy to set the stop loss either by pips or by amount or by percentage, either way. But as a general rule, you shouldn't risk more than 1 or 1.5% of your account size per trade. That's the professional size of the stop loss or your risk. And some traders use a lot higher risks, but it often ends in a disaster. So please choose a realistic size of the stop loss and always backtest it first. This brings us to our third stop loss, using a dynamic indicator-based stop. Let's get started. At the bottom of the chart, you see the ATR, the average true range indicator, which is often used for stop losses. It's set at a period of 14, and it's the average range of the last 14 candles. At the time of our trade entry, the ATR is around 7.6. You can see here at the right, the second last digit is the pip size. So we have a pip size of 7.7, let's say 8. Some people use the 1 times ATR as a stop loss, which would be 7 pips, which would be right here. But often this stop is used 2 times the ATR, meaning by 16 pips in this case, which would be right at 16 pips. And the 2 times ATR fits better to this price action here. If we compare it with the 2 options we had before, this level fits better, but as always, it's really individual and needs to be backtested. But it doesn't have to be static. You can also combine the different types of stop losses with each other. For example, in smaller time frames, I would recommend using the ATR, maybe in combination with a certain amount size. And in the bigger time frames, for example, the support and resistance levels are more clear than in the smaller time frames. Therefore, you can use the stop loss using the support and resistance lines there very well. Maybe also in combination with a fixed stop loss. This leads us to the end of this video. I hope you enjoyed it and learned how to set the stop losses in your trading correctly. And if you did enjoy, please leave me a thumb up and also subscribe to my channel for more interesting videos to come up. And if you have any wishes for further videos, please leave me a comment in the section below. See you soon!